Half an hour away from the Opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Let's get to your top stories today. China takes more steps to boost consumption with interest rate cuts on $5 trillion of mortgages expected to come this month. Now, President Xi Jinping is urging officials as well to make sure that annual growth target is met. Now, the dollar and treasury yields declining in the Friday session here, while Asian stocks are fluctuating after the latest U.S. data sustaining these bets on the Fed cutting rates, of course, hopefully next week. Plus, an exclusive with the head of the Philippine newly established sovereign wealth fund on where it's putting its money and what the challenges are looking forward.
Happy Friday. We made it. You take a look when it comes to markets, and at least we're still in a pretty upbeat sort of sentiment here this morning. We're seeing stocks actually gaining, yen holding that sort of rally as well, so 141 levels. So the dollar certainly dropped after we saw the ECB cut rates for the second time this year. They didn't quite close the door, I guess, on whether we'll see another cut in the next meeting or so, but still leaving traders a little bit wondering what's next really for the central bank. But overall, you take a look at what we saw. It was U.S. PPI prices that picked up slightly, a small pickup in jobless claims over in the U.S. as well. As Dave mentioned, maybe that helps to solidify the case for that cut next week, whether it's 25, whether it's 50. I think there's still that lingering possibility, some say, of that starter 50. The Fed's going to have to start big, and then...
Well, they better cut rates. Let's put it that way.
Well, that's the least of it, right? Yeah. But then take away how things are going. I mean, obviously, we're watching gold futures just after that ECB cut, after what we heard from the dollar. Really, you're starting to see gold futures continuing on and extending that rally here to that record high. We're at 2,591. When it comes to gold here this morning. So certainly that's one of the key things to watch here. NASDAQ Gold and Dragon not really doing too much, but we saw slight gains here. Doesn't really build much confidence really at a market when you take a look at what happened with the CSI 300. We knew this was coming, but we finally reached that mark yesterday at the close of reaching that 4-year low for the benchmark as well. So certainly that's one to watch here today. Obviously, we have a MPC meeting to talk about. There's a lot of speculation that they might actually be raising that retirement age. What does that actually mean? And then again, it's a busy weekend. They're releasing the data dump on a Saturday, Dave.
Yeah, which means we'll be glued to our phones.
Do we have to come to work?
I will, at least.
No, you won't.
Well, there's always online. But I mean, you're right? Because we're also in the window for credit numbers.
Yes.
Which they tend to release, and I know this from experience, happy hour on a Friday.
Yeah.
So will I have a cold glass of water in my hand?
Probably best.
The data starts to come through as well. So we have window. So yeah, we are in the window for credit numbers to come through. The data dump, as Yvonne is pointing out, is this time tomorrow. We have a 7-year bond auction today. And we'll talk more about the bond rally in just a moment here, because we're hitting new lows on the 10 and the 30 there. And of course, as Yvonne is pointing out as well, what we do get from the NPC Standing Committee, the readout will take place later on today. Right. In terms of this bond rally, right? So this chart coming up on your screens, you have momentum at the bottom, you have 10-year futures on price at the very top. Here's an interesting statistic. Over the past month or so, well, the past month, we've only had one down day on the Bloomberg China Treasury Total Return Index, which is basically everything close lower only one day in the last month or so. Underscores, for one, the deflation concerns, and number two, of course, this bond rally that seems unrelenting up until this point. So we'll see.
Yep, and let's get to our Bloomberg scoop. Big story here right now that we've learned that China is poised to cut interest rates on more than $5 trillion of outstanding mortgages as early as this month. Now, the move could help reduce borrowing costs for millions of families and maybe help boost consumption. For more, let's bring in our China correspondent, Min Lo, on just how big are these cuts and what impact could it have on the economy?
So we're learning that banks are preparing to adjust the mortgage rates by up to 50 basis points, although we previously reported that there could be a 2-step cut of a total of 80 basis points. So what this does is it shifts the timeline forward, because banks typically reprice their mortgages only in January, but this cut could come this month. And we know even though China has already lowered mortgage rates to record lows this year, that has only helped the new homeowners. And existing homeowners, their mortgage rates are still about 80 basis points higher than the new loans. There you go. And so what this does for homeowners is it could save them about 300 billion yuan in annual interest payments, and that could translate into 0.6% in retail sales and 0.2% in GDP. But the big caveat here is that modeling is based on the assumption that all of that interest rate savings goes into spending. But in this current economy, people might just keep them in bank.
And that's exactly what we've seen. Month on month, we've seen savings just pile up in the banking system. Well, that goes to show what the economic data probably looks like tomorrow.
Yeah, so for the August data, it's not expected to be very promising. We're expecting weakness across the board, fixed asset investment, retail sales. Industrial production expected to lead the declines at 4.7% versus 5.2%, or 5.1% rather, the previous month. Retail sales at 2.5% versus 2.7% the previous month. And this is disappointing because in August, we were expecting a boost to retail sales because of the summer travel season. But even then, it's not enough to offset the broad weakness here. And look at property investment down 10%, slightly better than the previous month, but still in very negative territory there. And you have President Xi coming on CCTV, state TV, to say, to call on provincial leaders to properly implement all the policies for the third and fourth quarter to try to hit the growth target this year, as economists shave off their growth forecast to about 4.8% for China this year.
Yeah, there's a 0.2% gap between the street and what the target is. Min, thank you so much. Min Lo, a China correspondent there. As Yvonne is pointing out, of course, we're going into the session today. CSI 300, 5-year low, consumer staples, underperforming, even an underperforming benchmark. And on the other side of the equation, the table is this unrelenting CGB rally. Let's bring in Mark Konyn here with us on set, CIO at AIA Group. It's nice to see you and good morning.
Thank you for having me.
Happy Friday the 13th. I just realized that looking at the calendar.
Lucky we're not superstitious.
Yeah. Well, what do I do about these markets? Let's start with China. And the confidence in the economy and the equity market is wanting. We're seeing that play out also in the bond markets as well. I think that's being kind, wanting.
I mean, there's no interest.
Yeah.
We're just talking there about consumption and whether or not these mortgage concessions will filter through and flow through to increase consumption. It's highly unlikely. I mean, most of what we've seen so far has been on the supply side of the economy. Yep. If you look at consumption, it's still well below pre-pandemic levels, whereas you look at industrial growth, it's now back in line with pre-pandemic levels. So that tells you everything. All the measures taken so far on the supply side, bolstering industrial output, industrial investment, nothing on the demand side. This is a demand side initiative, but probably consumption confidence is so low that the tendency is going to be to save rather than to spend.
And it seems like the catalyst people want is fiscal policies, right? What would satisfy you, Mark Konyn? Is it more about raising the budget deficit, for example? Is it more about special bond issuance? And what would satisfy?
So as an investor, I think what we want to see, given that most listed companies, a lot of listed companies, are geared up for consumption, we want to see an improvement in consumer confidence and we want to see demand-side initiatives. But clearly the policy is not focused on that presently, and I don't think it's going to budge in the near term. We were all disappointed by the third plenum through the year, and we're now, in that phase where market earnings expectations are still being marked down.
And so I guess it goes into, we've been hearing a lot how the equity market looks cheap. The bond market looks expensive. Is it, again, too early to make those conclusions at this point?
Well, I think the flow of funds clearly has been heavily in favour of the bond market. It's been a fabulous market, one of the best globally, very secure sovereign market, far less volatile than what we've seen in treasuries.
Not at all. Yes, absolutely.
So very different. So the mainstay, but clearly a lot of money has flown through to fixed income. Equities are moribund. There's very little to trigger interest, and that's likely to stay for some time until we really see the demand side of the economy pick up. What we need there is really fiscal initiative, but that's not on the table for the moment. And obviously we haven't said it yet, but the overhang of the oversupply in the property market is still working its way through, and without proactive policy to address that directly and at scale, it's going to take multiple years for that to unwind.
It sounds like you're looking elsewhere, Mark.
Well, we have a big business in China, so we have a big book to invest in China, and we're very active.
Okay.
But where we have optionality, where we're looking to move money around and take advantage short term, clearly China is not an overweight position.
What do you make of this global bull market? Equity. bull market. It seems to be consolidating for the last 8-9 weeks. We've seen a recent spark again when it comes to this Mag 7 pocket of Mag 7 stocks as well. Where do you think we go here with the equity market?
Well, we've been calling a broadening out in the US market for much of this year and have been mostly disappointed. Probably the last couple of weeks we've started to see a little bit of broadening out, but probably too early to call that. So there's a disconnect between fixed income, bond markets and equity markets. Equities still seem to be not too concerned about a sharp slowdown in the US economy. Bond market looks like it's seeing something different, where we're seeing, an expectation for rapidly cutting of rates and for multiple rates in response to economic slowdown.
Does that worry you to see these sort of differences in what people...
It keeps us busy.
Yeah, but
so
which side do you lean towards? I mean, is it really going to be a recession like the bond market says?
No, so our view is that is not for recession, certainly not in the next 12 months.
Okay.
We're actually quite sanguine on the economy. We think that the labour market is still holding up pretty well. Cost push is pretty much behind us. We're not seeing the sort of wage settlements that we'd seen previously. So disinflation is now very much in play. It does give the Fed the room to take their time, be data dependent, but starting obviously next week, and we see multiple cuts going through the next 6 or 7 quarters, but we don't see that number of cuts that the market is currently discounting.
We were talking just outside the studio before the show started, and I think it's a perfect jumping off point for the next segment. But if you could just lay out for us, you mentioned no recession, 12 months. What happens end of next year? And you flag a very nuanced risk that we could be looking at this time.
Yeah, so obviously as a long-term investor, we're constantly looking at ways in which there may be changes in expectations. And we know sort of 4 or 5 years ago, a lot of US corporates refinanced effectively at very low rates.
Right.
So it took down a lot of debt, and that's up for refinancing now at the end of next year into 26. At that point in time, the economy is clearly going to be on a slower path than it is today. So we see a soft landing, slowdown, not a recession, but it will be slower. So at a time when there's refinancing, bond spreads are likely to push out a little bit. Rates will be lower, but spreads will be pushing out. At that point, there is a concern that if corporates feel the squeeze, they'll start to cut costs, retrench, and that could precipitate a more significant slowdown in the economy. So further out, not being discounted currently, not a concern immediately, definitely not a recession in 25, but as we move forward into 26, we'll be very focused on how corporates face that sort of debt cliff.
Real quickly, how quickly or how much can bond yields reverse then, you think?
In the short term?
Yes, short term.
20 to 40 bips.
Oh, wow. Okay.
Probably overplayed at the moment. Every time I come on, we always say the same thing.
Yeah.
The bond market's overplayed its hand.
And it happens, though.
And it happens,
right,
yes.
Okay.
Mark, we'll have more.
Yeah.
Mark Konyn, the CIO at AIA Group, joining us a little bit later on the show. Coming up next, we're here exclusively from the president and CEO of the Philippines' first sovereign wealth fund and how they see the global rates environment impacting their sort of strategies and the like. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Welcome back. You're watching The China Show. Just to pivot and have a look at the Philippines right now. On your screens, the Maharlika Wealth Fund. That's the country's first sovereign wealth fund, eyeing its first investment by the end of this year? Question mark. The fund was established, of course, just very recently, back last year. Initial capitalization, $2 billion US. It's aimed at helping, of course, build economic pillars, areas like energy, infrastructure. Joining us here on set, President and CEO of the fund, Rafael is in town, of course, and joins us exclusive. Good morning. It's nice to see you. Are you guys on track to make that first investment before a year?
Yes, indeed. Well, thanks for inviting me. Yes, indeed. We're currently undertaking due diligence for quite a number of projects, and I really hope that by the end of the fourth quarter, we should at least be able to either make an announcement or an investment.
Can you give us a little bit of hints here on what you plan on investing? Is it renewables? Anything you can tell us right now?
Well, I've always said that this is going to be in the energy space, and that remains to be. We have, in fact, announced the memorandum of understanding for one of the islands. The rest I really can't talk about.
Okay, and just give us a sense of ticket sizes. How much Are your ticket sizes looking, at least in the initial deals that you're looking to announce?
Intuitively, well, it's going to be significant. Unfortunately, it's an NDA. We're subject to an NDA for the first one. However, for the one for the islands, we're aiming for about 100 to about 150 million US dollars in terms of rolling out transmission lines in the islands.
It's been more than a year since this law created for this sovereign wealth fund in the Philippines. Can you describe how progress has been so far?
Sure. Yeah, no. So, like what you said, the law was passed in July of 2023, and the board was appointed in late December, and we had our first board meeting in January. From the time to date, we've had signed about 6 or 7 MOUs. We've already established our governance. We're building the team. I think we've come quite a long way since then. And just like what I said, aiming to make our first announcement by the end of the fourth quarter.
How big is the fund now?
The paid-up capital is about 75 billion pesos, about 1.2 billion, 1.3.
And how are you guys funded?
It was capital seeded by Land Bank of the Philippines and Development Bank of the Philippines. And the rest of the funds are coming from dividends to be received by the Philippines from the central bank.
Right. Okay.
So what other sort of investments are you looking at? Maybe if we look into 2025 now.
Sure. Well, we're aiming really for about 4 particular sectors. Energy would be the first. And the rest of the themes really are built around food security, digital connectivity, healthcare. So these are the initial ones that we will most likely be announcing.
And is there a specific mandate to keep the investments onshore, or do you have latitude to be looking at things outside, of course?
No, in fact, the law gives a significant breadth in terms of asset classes, geography, and sectors so we can invest in.
Right.
But that said, given the fact that it's been seeded locally by the 2 banks, we've decided that in its nascent stage, we will be steering this as a national development fund. And then once we generate surplus revenues or surplus value coming from these, then we can cross the border and begin investing abroad.
Right. And is it mostly in, I would imagine, private markets, or are you looking to dabble somewhat in public markets?
No, yes, indeed. It'll be purely private markets. And any exposure to the public market will be part of a bigger M&A. But the framework is actually written for that of a private equity.
Okay.
Can you tell us what have been the key challenges that you face setting up this fund so far?
I would say we've actually been able to achieve exactly our timetable. Some of the I would say complexities really were we expected them, and they're coming to fruition now. But really, it's something which we did not anticipate.
Okay.
I think recently one of the big developments, correct me if I'm wrong, over the last 2 months, you guys established a risk management framework, and a lot of our viewers are watching managed funds in the private sector, in the public markets.
Correct.
How is it different? How is that framework different for a sovereign wealth fund compared to one that you would do for the private sector?
Yeah, well thanks for that. I would say that it will closely resemble private equity frameworks. But that said, where it differs would be the focus on socioeconomic development. So the way we've structured it, for example, is when we created the governance in the board, apart from the 2 committees that the law required us to set up, we in fact established 6 board committees. And the organizational structure is that these several departments have their own respective dotted lines to the different board committees.
Right.
So it's a one step more, I would say, more structured than the private sector, and then significantly more, I would say, better governed than many of the government-owned and controlled corporations, I'd say.
And I would imagine the LPs are also different, right? Because you do have, of course, as the government. So I'm wondering then, you mentioned with the focus being on, say, economic development.
Yeah.
Is that harder to measure future returns if it's something that has a social aspect to it than purely a commercial where you can measure and relatively see future cash flows coming in?
Well, the reality is that there are, in fact, formulas for you to be able to put in social factors, and that would be economic internal rate of return.
Yeah.
So whilst we calculate our IRR, our financial IRR, we also calculate our EIRR.
Okay. What are both? I'm curious.
Pardon me?
What assumptions are you making for both those ratios?
Well, we have our KPIs approved by the board. Unfortunately, it's kept kept very confidential.
Okay, fair enough.
In terms of our returns, our expected returns.
It looks like you're about to make some sort of investment into the power grid in the Philippines. This is the National Grid Corporation of the Philippines. How do you see this standing, with your priorities, Maharlika?
I really can't talk about that. My apologies, because we do have an NDA.
Right.
Are you in active talks at the moment?
Pardon me.
Okay.
I beg your pardon, really.
No comment is fair.
Yeah.
Well, I guess the other question that comes to mind really is, in the news we always see and we always report on the tensions going on, and not to get into politics, between the Philippines and currently with China, and parts of the South China Sea. And I'm wondering whether or not that showed up in your conversations, in your sort of potential universe of options right now, or whether that's actually started restricting things.
No, as a matter of fact, we're very open to investors from different countries. So hence, China as an issue has never crept up.
Right.
We have absolutely no problem co-investing with them in the Philippines.
And you're in town for what brings you to Hong Kong? And how's your trip been?
So far, very productive. I'm here for the SCMP forum that's happening in about an hour.
Okay, well, on that note, I think you still have a way to go from that. Thank you so much for coming here.
Of course,
we'll let you go. Of course, busy day ahead. Rafael Konyn, their president and CEO of the Maharlika Investment Corporation, joining us here, of course, on set this Friday. Speaking of, and coming up here on the show as well, the Philippine Undersecretary of the Department of Trade and Industry will also be joining us later on to discuss specifically Manila's efforts there to attract more FDI into the country. Catch that interview at those times later on in the show. Coming into the open today, under 7 minutes away, futures are pointing slightly higher in the Hang Seng Index. We're better by 60 points. The opening bell, 6.5 minutes away. This is Bloomberg. Okay, the Friday the 13th session is just a couple of minutes away, and here we are. As our guest pointed out, it's a good thing we're not superstitious here. Going into the open today, a third of 1%, 17.3. We are coming off, of course, a 5-year low on the CSI 300. So are there tactical opportunities there going into the session today? We have some data to show you a bit later on in the show. If you can take advantage, of course, of these levels.
All right, you take a look at what analysts are saying here. Citi had an interesting note when it comes to some of these Chinese airline stocks. So downgrading the likes of China Eastern and China Southern, they're basically saying concerns are around prices that are weakening. Business trip demand is also slowing. So they're saying the summer really did show features of good volume, but weaker prices as well. So they're downgrading those two stocks. And China Tourism Group, duty-free, those A shares cut to add at Changjiang.
Yep, looking at some of the property stocks in focus today on the back of what we could be getting as early as today, that readouts out of the Standing Committee, of course, that meeting, which could include many other things. We'll talk about on the other side of this break. Gold, of course, is bid. The open is next. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down the open of markets. And on this Friday morning, we're still seeing some equity gains here this morning. So some data out of the U.S. certainly seem to solidify the case of a cut next week from the Fed. But keep in mind, it's going to be busy. We talk about BOJ, Fed, BOE all meeting next week as well. So it's going to be a cocktail of lots of central banking for you. 7-11 for the renminbi. We've been seeing when it comes to the fix too, Dave, that the PBOC is letting us things a little bit more loose of late here, not really pushing back against this renminbi strength.
Yeah, well, they have to contend less with a stronger dollar, right?
Yeah.
I think if I have my statistics correct, I think the dollar index, specifically DXY, is on track for the 9th week of losses in the last 11. So that really has been somewhat clear. And I think the conversation too, and we can talk about it later, of course, our question of the day is on the back of the ECB decision yesterday, can the euro now effectively outperform? Back into the China story. So a couple of things I want to note here. Of course, the property index is in focus today on the back of what we might get in terms of that reduction in the mortgage rates. That's number one. Number two is this unrelenting rally. We're still seeing downside across the CGB curve right now. Your 10 and your 30. We have a 7-year bond auction today. Moutai on the consumer staples story closed at a 4-year low. This index closed at a 5-year low. 31.79 was the level we were tracking for about 2 weeks now, and we eventually took it out into the close yesterday. We're looking at some data on oversold and what that might mean for a tactical rebound. I'll show you that chart in a moment here. Of course, this is one stock we're tracking. We'll show you that too in a moment here, because we are likely going to see one of the biggest listings in Hong Kong next week. 8 shares, and at 61.80. In fact, I'll talk about it later. Flip the boards first. We'll talk about Hong Kong first. The open in Hong Kong is this, 17.3. Slightly to the upside. H is stacked, so that doesn't seem to be a tech story for now. And some of the big names, of course, bottom of your screens. We talked about, of course, where we are here with the dollar. Interesting conversations going on as far as the Hang Seng Property Index goes, given how much falling rates would actually help. Just keep in mind also tomorrow is we have the data dump coming through on a Saturday. And in between, or who knows, maybe at the same point as well, we get the credit numbers coming through. And alongside the data dump will be new home prices, which are arguably perhaps the most important there as well. Right, a couple of movers we're tracking here. Beijing down substantially. A and 8 shares yesterday. A shares up at 2.5% right now. Gold, for obvious reasons, where gold prices are at 2,600. Gold mining stocks very much bid. NIA, of course, big declines in the EV space overnight. We are seeing a catch-down trade as far as some of these names are concerned. And we talked about this earlier on, right? So these are the A shares, 62.11. And based on some of the reporting we're doing right now, we could be looking at an IPO price, I believe, at about 54, if I'm not mistaken right now. Now, if you do thank you so much, 54.80 for next week. This is traded that's in renminbi. So what is the exchange rate? I think we have an exchange rate coming up on your screens. Yuan, Hong Kong dollar, which translates to about, I think, 56, given the current exchange rate. Right now, what is it now? 91.91, about 56 bucks, yeah. So still trading at a premium to what the price might look like next week. Okay, as promised, very, very quickly. CSI 300, 14-day RSI, price at the top, RSI at the bottom. We've been at we've been here several times throughout this bear market. We've seen a substantial tactical rebound on only 2 or 3 occasions. That was back in 2022. The rest, though, there's not a lot of information right now to determine whether or not you should be buying this dip now that we're here again. So I guess we'll have to wait for that next catalyst, Yvonne.
Yep. We're taking a look when it comes to that Chinese 10-year yield, though, Dave, and we are hitting now a fresh record low this morning. So we did briefly touch that 207 sort of level here. And obviously, what we've been seeing is this PBOC with this whole Operation Twist and trying to steepen the yield curve. It really hasn't done too much in terms of really stopping this rally, particularly on the long end. There you go, 208 levels here right now, but certainly a lot of questions on what more can they do. Are we likely to see more action being taken place from the PBOC? Yeah, and I guess while confidence is wanting in many places except for this one as well, I think let's bring in Mark Konyn here to talk us through some final thoughts as we go into the weekend here. Mark, one of the things we were talking about earlier on is why is there so much money still going into cash at the moment when rates are about to come down? I guess it's the other part of that question. So it's certainly in China, it's confidence, which we've already talked about. Yep. The lack of confidence, a very, very narrow range of options you have to invest. There are also a number of measures being imposed on the financial sector, including more recently mutual funds, which make it more difficult in terms of personal liability and the rules of the game, so to speak. What we've seen as well, despite the fact that we have sort of record trade surplus for China, a lot of that money hasn't flowed back to China. It's being held offshore, and it's being held not in RMB. So if you look at RMB deposits in Hong Kong, for example, they're very low compared to what you normally would expect with such a trade surplus. That may be changing now because with the PBOC allowing the currency to appreciate effectively, that may pull some of that cash back. At the same time, if you're seeing US rates start to come down, we might see a reversal of that. And that would be good news because what we really need to see is reflation onshore in China. This is the longest period of deflation. It's expressing itself through the bond market clearly. Any amount of policy change aimed at curve twisting is unlikely to be successful unless you have that reflation coming through. We've been talking about these repatriation flows. You could add that to the yen as well. I'm just wondering, where are we in this, this carry trade?
So the reversal or breakdown of the carry trade was the big event of the summer, of course, and I think a lot of that is responsible for explaining what we're seeing in the US bond market as well, with these expectations of rate cutting expressing itself through very much lower yields across the yield curve. Some of that is the carry trade unwind. Borrowing cheap in Japan and buying copper and commodities, when you're hit with margin calls and a reversal or a weaker dollar, etc., that starts to reverse. That has a significant impact on fund flows, and that's what we saw in the summer. So that's hanging over everything, and that's going to unwind over a very long period.
Is the most violent bit of that unwind behind us, though, or is it difficult to say?
I think the realization, the shock of it, of the end of that has occurred, but the market's recovered fairly quickly, as we saw. Equity market, perhaps the most violent in that sense. But that theme is going to play out over multiple months and years.
Yeah, we talk about next week being busy with the BOJ, the Fed. How are you positioned leading up to this meeting now?
So cautiously, I would say at the moment, because I think it's a case of all the pre-positioning has taken place. When the Fed announces what everyone expects as the rate cut, I think we're going to start to see rates back up.
Right, and you said what, 40, 50 basis points is what you're expecting?
20 to 40.
20 to 40.
Yeah.
How many cuts are priced? I think 10? 10 cuts are priced to the end
more
of the cycle.
more than we think. We're looking at probably 5 or 6 cuts, quarter-point cuts over the next, 6 quarters, say.
So how do I think about duration currently at these levels?
Yeah, so probably not adding to duration immediately, if our view is right that the yields will back up. But once they do, if they do, that's a good entry point, because then we're going to see the effect of the rate cuts coming through successively over future quarters.
Yeah, we've been tracking the story. I mean, obviously the Standing Committee meeting and NPC in China, one of the things that they're proposing is raising that retirement age.
Yeah, have to. Inevitable.
Yeah. How does it impact insurers like yourself?
Well, the demographic trends are already in play. You've seen it in Japan, you've seen it in countries in Europe, developed countries in Europe. Korea is a great example, where you have an aging population, shrinking birth rate. It puts a lot of pressure on the government, potentially, to fund long-term financial support in retirement. So there's a tendency to try and create more an environment where people are more financially independent. Part of that, of course, is to get people back to work and to work longer. We've seen it in many countries. It's a global theme. That's going to play out in China, we think. For an insurance company that's providing services, both accumulation, saving long-term, that becomes more of a feature in the product range, whereas historically more protection. So alongside protection, you're going to get more savings products. And then, of course, as people get through that period and start to look at income coming from their savings, decumulation products start to become more important. So that's all ahead of us in China. So it's a very exciting proposition as we think about building our business over the border into China.
And just looking at the Japan example of that, does this look like a promising endeavor in China, getting productivity?
Well, the last 20 years, so Japan did 2 things. One was bring women into the workforce more effectively, and more importantly, extended the retirement age. And that had a big impact. It softened the impact of the effect of the demographic shift on productivity and the economy. That's pretty much run its course now, and people are not going to work forever. But for China, they've still got that card to play.
Mark, have a great weekend ahead. Nice to see you.
Thank you very much. Great to see you.
Mark Konyn, their CIO at the AIA Group. Plenty more ahead here on shows. Happy Friday, by the way. This is the China Show.
All right, welcome back. Sources tell Bloomberg that Jack Ma's backed Ant Group is refinancing an offshore credit line of about $6.5 billion. The move comes as the once dominant fintech company expands its global operations and seeks to recapture some of its lost glory from before that government crackdown. For more, let's bring in our chief North Asia correspondent, Stephen Ingles. What do we know at this point, Steve?
Well, we know that Ant, of course, would like to recoup some of that past glory before. It's almost 4 years ago now, remember?
Yeah.
In October and November of 2020, when that big world-beating IPO that was going to be, of course, in New York and also here in Asia. And it was scuppered at the last minute. And then, of course, there was a regulatory crackdown that lasted multiple years. And essentially, the valuation back then put Ant Group at about $280 billion. Last year, when there was a share share buyback of private investors. It was valued at about $73 billion. Also, in the March quarter, this is a company that saw its net profit fall about 10%. So they've been doing restructuring, government mandated, of course, but they like to get back to those lofty valuations, no doubt. One way to do that is to concentrate on the tech side of fintech, because right now in China they are being regulated as a financial company. But again, we've seen the valuations on Wall Street. There's a premium for the tech side, and especially those tied to AI with the Magnificent Seven and the like. So what we're hearing from sources is that they're refinancing this offshore line of credit to the tune of about $6.5 billion, and the international division will be allocated about $1.5 billion of that borrowing quota. So again, they are trying to expand beyond China with a slowing economy there. They've been expanding the Alipay Plus platform for international transactions throughout Southeast Asia. They want to go further afield. They also want to start loading their large language model and their AI capabilities into some of their services, including this Zhi Xiaobao, which is a life assistant. So again, they're trying to leverage off their AI capabilities, emphasize the tech, and see where they can go from now abroad.
Yeah, but how important is that to be, I guess, in some ways recognized as also a tech company?
Yeah, I think there's probably a stigma right now that Ant Financial is a financial company. And I think it's about, after 4 years nearly, of really an overhaul of this company. I mean, Alibaba's been overhauled as well. They were going to have 6 different divisions. They got they scuppered that as well. So there's been obviously some investor confusion a little bit about Alibaba. Same with Ant Group. So I think they're just trying to essentially redefine themselves in many ways, come out of that regulatory crackdown period of 3+ years and establish themselves as not only one of the largest, if not the largest, payment platforms, Alipay and Alipay Plus, but also have those tech offerings on top of it, which feeds the services that are intertwined into Alipay Plus.
Steve, thank you. Stephen Engel there, Chief North Asia Correspondent. I was looking at the calendar, November 2019 since when that deal was scuppered, so it's been 5 years now. Right, speaking of deals, speaking of going public, we're hearing 2 of China's most prominent AI chip designers could soon actually list. Annabelle, of course, our tech reporter is here with us to talk us through the information we know from our sources. And I've got to tell you, a lot of people have probably not heard about these 2 companies.
That's okay. I'm here to share information about them. But they are 2 of the most prominent chip design firms in China. And so there's Biren, and then there's also Enflame. Biren is actually backed by Tencent. Enflame, we're hearing from sources, is looking to raise up to $280 million. And yes, it's a real question or challenge for China, because it is blocked from some of the most advanced chip-making technology, some of Nvidia's most advanced chips. It needs to develop its own homegrown sector. And that, as we know, has been a big policy push of China's, that they really want to see these firms encouraged to develop and support and find those local alternatives. So we're hearing that Enflame and Biren could both be looking to list on the Shanghai Star Board. We know that that's a bourse that's been very friendly to those more high-growth startups, but even if they're loss-making, they're still willing to accept the applications. We are understanding that both of these companies are looking to file their documents quite soon. They could actually list as soon as within the year, early 2025, another option here. But certainly there is that growing appetite we see for domestic players that are looking to challenge Nvidia in the space.
You mentioned about Nvidia. We have got to talk about OpenAI. I mean, what a week it's been. We talk about this potential fundraising that they're doing. Now they're talking about releasing this new AI model. What do we know about Strawberry at this point?
Strawberry is the internal name, but externally it's actually known as O1. So this is a model that the company says has some sort of reasoning capability. Now, you need to think about reasoning in the computing sense and what that actually means. And in the computing sense, it essentially talks about having human-like intelligence. You're creating a model that has the capacity to consider lots of different inputs, lots of different types of knowledge, and then use reasoning to create something that it determines to be an accurate answer. And that's what OpenAI is saying that this model has, O1, that it can use this sort of reasoning capability. And so this is something that's going to be available to select OpenAI customers or ones that are sort of paying for the service. And then they're going to be working on regular updates and improvements to the system.
Can't seem to wrap my head around this overall? Like, what is that user experience going to be looking like?
I think it will largely look to the same to some degree. When you listen to the videos that OpenAI has posted online talking about the user experience, it's sort of like you might need to just wait a beat. And the way that they're thinking about this is, if you use, and a lot of people would have used ChatGPT or equivalent, and you put in a question like, what's the capital of Italy? Well, most people would know it's Rome. And so that answer comes out instantly. This is something where you're trying to ask it a more complicated, more nuanced question, and so you just need to wait that beat, and then it will provide the answer.
Let it think. Yeah.
So it just needs a little bit more time to think around a more complex question, but they're saying that this has got a lot of different applications, not just in English, in maths, in physics. They even asked it to solve a crossword puzzle. You know, this is sort of what they're saying, I guess, is just the beginning of the next iteration, but a very competitive landscape, because you've got the likes of Anthropic and Google that already say that their advanced models also have some of these sort of same capabilities.
All right, Belle, thank you. Annabelle Julius there, our tech reporter, on the latest stories there. And, of course, we're still watching some of these markets in China that continue to head in opposite directions, stocks and bonds, right? You take a look at how the CSI 300 is doing. At least we're coming off the lows that we saw from 5 years ago. But, yeah, it's pretty marginal today.
Yeah, in fact, we're at about that level currently, 31.79. And to your point, right, the 10-year yield hit a new record low a couple of minutes back. An update here on your 10-year yield going into this break. And do not go away. We'll be back shortly.
Welcome back to the China Show. Well, Boeing's union members have wrapped up voting on their first comprehensive labor contract in 16 years. We understand that the counting of those votes is underway here this morning, and it sets the stage for a potential strike as the plane maker works to recover from a series of manufacturing missteps. Let's bring in our Bloomberg EV supply chain and aviation reporter, Danny Lee, on what could actually happen with this strike and how long the stoppage could be.
Yeah, I mean, there's so much unhappiness once the union leadership and Boeing announced this tentative deal. And so we fully expect actually there to be a rejection, a wholesale rejection. But we'll see 2 votes and 2 results come out tonight. Whether the members, the 33,000 members, reject this deal, and then subsequent to that, will we see enough people? We needed 2/3 of votes to also back a walkout. So it's not necessarily a clear-cut strike immediately from midnight on the West Coast, but clearly the sense of how strong this vote is, particularly for Boeing to see this rejection, and potentially how much it would have to pay more if these members are so unhappy that they want to see bigger pay rises. And let's not forget, they were union members who were looking for more than just a 25% pay rise over 4 years that Boeing was offering, and particularly as they were removing these annual bonuses as well. So a lot of contention here, and it doesn't matter if you're going to be Boeing and offering 11% pay rise immediately. It feels more of a reduction when you lose that bonus as well. So there's a lot still here to play for.
And what are the likely, I wouldn't say outcomes, but what are the likely paths this story probably takes in the next few days or so, beyond this vote, of course?
So if there is this walkout, this could last many, many weeks. You know, Boeing clearly wants to avoid all of this because of the financial stress and the disruption to production. Clearly, it's already under a lot of strain. The fact that its production of its cash cow 737 MAX is capped, it still has a lot of issues to sort out regarding quality. So it can ill afford to have this unhappy workforce at its key factory in Seattle to disrupt proceedings. But for the new CEO, Kelly Ottberg, he has a lot to deal with the workforce, with production, with other business units underperforming, and so he has a lot to try and contend with, and his efforts to try and intervene in this negotiations to try and get these workers on site hasn't seemed to have worked given the level of strength of unhappiness here.
Danny, thank you. Danny Lee there, our EV supply chain and aviation reporter. Let's stay on the transport theme here and start things off here with some of the stories we're tracking. And GM, General Motors, is said to be in discussions to buy EV batteries that would use tech from China's CATL and would be assembled at a new plant set to be built in the United States. Now, sources say the factory would be funded and operated by Japanese firm TDK. They say that the deal could change depending on the outcome of the U.S. presidential elections, of course, coming up in November. Now, Millennium Management, and this was the big news, of course, overnight, looking to raise, get this, between $7 and $10 billion of new capital in a structure aimed at giving the firm a more permanent source of cash. And the firm is, well, taking a page from private equity firms and raising money that's, well, for one, callable, rather than taking it all at once. Now, the new iteration allows clients to then make pledges that Millennium can tap over time.
All right, another check of movers here this morning, and we're watching very closely what goes on with some of these property stocks. We talked about, that Bloomberg scoop about how China may be ready to cut rates on $5 trillion of mortgages as soon as September. You are seeing most of these developers are rallying quite hard here this morning, with Logan Group really leading this board up some 4%. Keep in mind, though, that Bloomberg Intelligence gauge of property developers, I think we basically sunk to 4-month lows just this week on news of the likes of Shimao being taken out from the Stock Connect, for example, as well. But certainly we're seeing a little bit of rebound here underway ahead of that MPC meeting later on today and that readout that could come out in just a few hours. In terms of the dashboard, of course, we're taking a look at what goes on with that CSI 300. So rebounding from those 5-year lows that we've seen, but we're still watching that CGB market, right? 208 for your Chinese 10-year yield. We're still hovering around those record lows here this morning, but the Hang Seng and offshore doing better than Shanghai this morning.
Yeah, and certainly coming up here as well, does it make sense to still buy into these bonds at these levels? It really depends on really what your assumptions are as far as growth is concerned. If you ask the street, it's 4.8%. The target of the government is 5%. Xiao Jiajia joins us with a preview of the data dump, which comes out tomorrow, plus, of course, unpacking this potential plan to raise the retirement age and what it means for the growth potential of the country.
Welcome back to the China Show. Here's a look at the CSI 300 just a half hour into the session. And yes, there's a little bit of recovery here after we did talk about those 5-year lows that were reached yesterday. So a slight uptick there. Hang Seng, MSCI China, though, we're seeing gains about 1% so far this morning.
Yeah, and so that's going up. The other thing that's going up, too, is the bond markets ahead of that 7-year bond auction. And certainly the long end, and as you can see, unrelenting. Is the word we've been using all week. It's certainly when you look at price every single day. The 30-year yield's at 2 basis points lower. The 10-year yield hasn't been at these levels ever. And certainly it's something to watch as we, I guess, pivot. And, the inflation numbers which came out this week underscores why this rally is still taking place. In fact, if you draw and you take a look at price action over the last 1 month, and we have a gauge on Bloomberg that tracks Treasury bonds effectively in China. There's only been 1 day where this benchmark has closed lower over the past, over all the trading sessions over the last month or so. So that just underscores the one direction, in other words, this group has headed in. Gold has been largely not as consistent, but certainly still been also one direction so far. And as you can see, that's playing out as far as some of these the equity plays are concerned with gold prices at or near record, depending on which contract you're looking at, 2,600. Asia ex-China, looking at the latest equity market. So we're getting a bounce on the Hang Seng Index, a bounce CSI 300. Nikkei's it's really been dancing to its own tune largely recently. And we're coming off, of course, that ECB decision yesterday. And certainly, could they follow up in October? The door still is open for a cut in October. And apart from that, we move into central bank week. Very, very quickly, the dollar, I think we're like 9 weeks in the last 11 that we've seen declines in the dollar index, and this is where we are as far as the dollar index is concerned, going into not yet the weekend, not quite yet. A few more hours.
Not quite yet. And we have a data dump in China, so it's not quite the weekend just yet.
Tomorrow,
That's happening tomorrow. But yes, but next week we talk about how busy it really is going to be for some of these FX traders, right? You're talking about the Fed, the BOJ, the BOE as well. Let's bring on Mark Cranfield, MLI strategist, joining us out of Singapore. I see a euro dollar at 110. I see people still thinking, hedge funds, that the yen can continue to rally. What does this mean for the dollar? Can it continue to weaken into this Fed meeting, Mark?
Yeah, I mean, the momentum is there. It already was to some extent, and then it has been refueled. There's this story that traders are kicking around today from the Wall Street Journal suggesting that 50 basis points is a discussion point for the Federal Reserve next week. That's actually nothing new, really. I don't think anybody would have imagined that the Fed wouldn't discuss 25 or 50 basis points next week. Getting a consensus for 50 is the difficult part. But of course, when you're in the mood anyway to sell the dollar and you're looking for reasons to do so, that's just another factor to put into the equation. Of course, it's helping to fuel the Treasury market as well. We're seeing short-term yields come down even further this morning. It's not just in China where yields are falling. Two-year yields have dropped by an unusually large amount in Asia today from the US Treasury market. So there's clearly people willing to put their money on the table that something big could happen from the Federal Reserve next week. But that's not the whole story. What's happened in the past 24 hours as well is you've seen some hawkish comments from the Bank of Japan. They have their own meeting next week. We've had at least one BOJ guy suggesting that Japanese rates need to go to at least 1%. Well, that's way above where they currently are in terms of their official rate. And then, of course, you can throw the ECB into the equation as well. We can talk about that if we've got time as well. So there's a whole bunch of things coming together. And it's not just about the Fed, it's about the divergence between central bank policies, and that's playing out in the foreign exchange market especially.
Yeah, Mark, in fact, why don't you talk about the ECB? And just before you do, I think to underscore your point just there is, I think Mohamed El-Erian, in one of the stories we woke up to this morning based on the conversation, was he thinks the markets lack a dominant view of how economies look going forward. Is that a sort of accurate representation of just this, why we're seeing gold at this level, why we're seeing credit spread so tight, why treasuries feel like an asteroid's about to hit Earth? Just your take on that, and the ECB.
It certainly makes it easier for traders to exploit weaknesses. If they sense that there is no consensus trade there, then they will look for the gaps in the narrative, look in the way the central banks are maybe going in different directions, and that can really help to fuel some pretty significant moves. So what you had from the European Central Bank is they've given really no guidance at all on when they might lower interest rates again. Now, that in itself is not a hawkish outlook because, of course, they just cut rates. But compared to what the Federal Reserve is looking like, it certainly makes the European Central Bank look a little bit tighter. And, of course, that translates into the euro currency. Now, when the euro is on the move, it's the second biggest currency in the world. So when the euro is moving, that's a huge indicator across the foreign exchange platforms. And that's partly why Asian currencies are having a very good day today, because everybody needs to put the euro, their weighting in various Asian baskets is very high. So a strong euro immediately translates into strong Asian currencies, not to mention the rest of the G10 space as well. So that's a very significant development. If the ECB is going to hold back and not lower rates so quickly, the flip side is that that's more downward pressure on the US dollar if the Federal Reserve goes with the path of interest rate cuts, which traders are kind of expecting at the moment. That's a development in the past 24 hours or so, and that's why you're seeing the dollar so weak today.
And with China, I mean, we have a data dump coming up this weekend. We have CGB yields that are back at record lows for the 10-year mark. Where does it leave the currency here right now? You're watching for certain levels.
Well, the central bank in China, clearly, you can tell from the way they did the fixing again today and the way they've been fixing all week. They're holding back their fire. They know that the dollar is extremely weak, but there will be a point at which they will want to try and blunt the strength in their own currency. They wouldn't want the yuan to outperform other. It's okay if it underperforms Asian currencies and G10, that's okay. They can't really resist the dollar going weaker on their own, but there will be roadblocks along the way. The immediate one looks like 705. There's a lot of option positions around that level. The PBOC will be aware of that, and you may see them start to slow down the progress of the yuan as we get towards 705. 7 itself might be a psychological number. It isn't really that significant to the central bank. But from here downwards, you would expect that dollar yuan would run into a few resistance points from the central bank as they try to keep the yuan relatively weak compared to other regional currencies. They can't do much about the US dollar, but they can make their currency look a bit more attractive compared to the rest of Asia.
Mark, thank you. Mark Cranfield in Singapore for us, our MLive strategist. Just ahead here and shows China is set to lower borrowing costs for millions of homeowners with a mortgage rate cut expected as early as this month. The details of that potential move just ahead. This is Bloomberg. Okay, about 40 minutes into the cash market session, last one of the week, and as you can see, we're looking at property counters leading some of the gains here, maybe on the back of some policy support, which might be forthcoming today, and certainly the conversation on the street is perhaps a lowering here of interest rates for refinancing. $5 trillion, of course, is, what will the outstanding balance of what could be affected by any lowering of interest rates. Let's bring in Min Lo, our China correspondent, to talk us through how big the cuts are likely going to be and how likely the impact is going to be as well.
Yeah, so far we are hearing that some banks are preparing cuts of as high as 50 basis points, although previously we have reported that it could be as high as 80 basis points in total in a two-cut process. So what this means, because the cuts are coming as soon as this month, it moved the timeline forward because typically banks would only reprice mortgages in January of next year. And this would impact the existing homeowners because although China's mortgage rates is already at record low for new homeowners, the existing mortgage, you can see on the screen, is still 4%. 80 basis points higher than the newly issued loan. So this would save consumers about 300 billion yuan in interest payments annually. It could translate into 0.6% in retail sales, 0.2% in GDP. But the big caveat here is that economic modeling is based on the assumption that all of that savings translate into spending, which we know in the current economy, a lot of people might just keep it in the banks. And the other thing it would do is also cut into profit margins of banks as well, which is already at record low. In June, it was 1.54%, I believe. So this is essentially, asking the banks to carry out national service, to transfer wealth from the banks to the consumers.
Another thing we're looking ahead to is this MPC meeting later on today. There seems to be this proposal that's going around to raise this retirement age in China, Min. If approved, this would be the first increase we've seen in over 4 decades. How significant is that?
Yeah, it is very significant. And it's not the first time that the government is mulling this. They looked into this back in 2008, but then they backed away because of public backlash. And now, once again, we're seeing this topic trending on Chinese social media. And you're getting a lot of pushback, not just from the older folks who are obviously not happy about working longer years, but young people as well are saying they are worried that if the older folks are staying in the workforce longer, they're taking away jobs that could be open to the younger people because we're in an environment where you have unemployment rate at 5.2% last month, youth unemployment still very elevated. So the entire labor market is very competitive now. You have the so-called 996 culture, 9 a.m. to 9 p.m. 6 days a week. And so if you talk to young people, they're saying that this raising the retirement age is like handing them a sentence. They're not happy. And by the way, we don't know how high they will raise the retirement age yet and whether it will be voluntary, because at the third plenum, the government said it could be a voluntary move. So if it is, how many people are going to raise their hands up? And, would that then diminish the intended impact of this policy in reducing the drag on growth?
Okay. Well, very quickly, Min, that's the short term. Longer term, though, is this a necessary move?
Yeah, well, right now, there is, in fact, a lot of room to raise the retirement age because China's retirement age is at the lower end of the global spectrum. It's 60 for men, 55 for women who are white-collar workers, and only 50 for women who are blue-collar workers. So it's something that makes a lot of sense for the government. It will have an impact in reducing the growth slowdown because of the demographic drag. But in the short term, because of the deflationary environment, it could exacerbate the existing fears around job security and income growth. It could be a dampener on consumer sentiment.
All right, Min, thank you. Our China correspondent, Min Lo there. Let's bring our next guest, Xiao Jiazhi, Chief China Economist at Credit Agricole. She joins us here in our Hong Kong studios. Let's talk about this whole pension reform. I mean, how significant do you think it's going to be in really changing the demographics of China right now?
Right. I think it's a positive step from a long-term perspective. They are doing that structural reform, which is quite necessary from the long-term. If you look at the labor supply, if you look at the productivity and etc., I think, and also look at the physical resources and the pension fund availability, I think this is definitely needed. But I think in the near term, the government would have to be quite careful in terms of how can roll this out in a gradual go, gradually, and also introduce some flexibilities, and also consider trial phases. So I think we are going to hear more about the outcome, but I think it's more likely it's going to be quite a gradual process to manage the expectations and to stabilize the sentiment to the very least in the near term.
Yeah, it's a difficult and tricky situation because, to your point, the economic fruits might only be visible and felt in a few years, but the social conversations are taking place immediately. When do you think we'll see the economic benefits of such a sort of complex endeavor?
I think given that this retirement age setup is really outdated, is just Mimi just mentioned 50 for female, 55 for the female managers, and 60 for the male employees. This is very early retirement if you look at it internationally. So I think China is right step for China to really catch up. But I think in the very short term, I think the impact, for example, China would definitely consider only to push back the retirement age by only 2 or 3 months per year. And this whole reform process could take 20 or even 30 years to complete to match the current international standard. So in terms of the real economic impact, I think it would have some help to the pension fund because there have been China academic, reports suggesting that China's pension fund might be depleted by by the year of 2035. So by delay, this retirement age could definitely help, but this is not the only thing that China could do. China could also introduce other ways to increase the contributions to the pension fund. But again, I think the timing could be a little bit tricky for Chinese government. So I think, for example, they could consider to introduce on a trial basis to let the public sector employees to go first, or allow those people who are up for delayed retirement to enter these trial phases first.
A lot of the comparisons, and this is a problem that isn't new, right? We knew that this was a challenge China had to deal with, and a lot of the comparisons were made with Japan. And I'm wondering whether some of the lack of inflation we're seeing today, do you think, looking back, it's partly because we had a shrinking labor market? How does that look, looking back at the data, for example? Why is China undergoing or seeing some of the deflationary forces we're looking at today?
I think a lot of the cyclical, stress are coming really from the property market correction.
Okay.
So if the property prices are continue to decline, fail to stabilize, a lot of the urban household, and they would file rather, don't really have a very strong appetite for consumption demand. And that from the demand side. And on the supply side, China's manufacturing space is really doing quite well, have enjoyed, the growth has really outperforming the other sectors. So that, catch up in terms of supply, when the domestic demand is relatively weak, that could create certain kind of imbalance in some of the consumer goods sectors. That would also have an impact on the, inflation front.
Right. We were looking ahead to this MPC. I'm just wondering, it was a year ago at that meeting that what we did hear a little bit more about fiscal policies, whether it was raising the budget deficit, whether it was about special bond issuance. It seems like there's more calls for that 1 year later now, too. What are you expecting?
I think on the fiscal front, China definitely has more room to do more. Whether it's like an outright increase of the fiscal deficit this month, it may not be that urgent. I think the near-term focus really for Chinese government, whether they can, accelerate the pace of the government bond issuances and also allow broader usage of those special bond issuance that have raised. So, for example, to to support the local government to purchase existing housing inventories. That has been discussed.
More demand side.
Yeah, so exactly. So, and also whether, the central government could use more of the resources to coordinate the local government to spend on some of the strategically important infrastructure. I think there is definitely a lot left to do for the government to accelerate the implementation pace of what they have already rolled out. But if we look at how the Chinese bond market today, and also the relatively weakness in the domestic demand, especially from the private side, certainly Chinese central government consider their relatively healthy balance sheet. There's room for them to raise debt. I think that is quite possible. Yeah.
One of the demand side measures we could get to this, I think Min was just talking about as well, is reducing the mortgage rate, which maybe allows more money to flow, hopefully, into the economy. Is there a way that we can model what that boost to consumption looks like at that point in time?
I think, we had some estimation as well. So if China could introduce a lowering of the interest rate on existing mortgages, I think the estimated amount would be about RMB 100 to 300 billion. It depends on how big the cut it could be and how this widely implemented could be. So that would be equivalent to about 0.5% of the retail sales, or 0.2 to 0.5% of the disposable household income. But whether this would be all spent, I think they would have to further get their confidence level a little bit boosted. We have to see better signs, for example, in terms of the labor market conditions, and also potential stabilization of the property market. And we are seeing that the property market home sales seems to be the decline in terms of the sales is declining, but it's also because of base effect. Whether China could introduce more of the meaningful measures to help on the property market, I think is quite helpful.
What does it mean for what we're going to get for the activity data tomorrow then? I mean, is this recovery losing speed as, more and more?
I think for the upcoming activity data, I think it is likely to serve as another evidence that we are still seeing a little bit of further weakness at this moment. I think IPFI retail sales growth could all ease a bit in August compared to July. I think what would be quite interesting for the market to watch will be definitely in the retail sales, which has been underperforming other activity growth data for a few months now. I think retail sales in August could still have a little bit lower growth compared to before, but with the Chinese government introducing, for example, more of the measures in terms of consumer goods trading and more supports in terms of auto, the data might look a little bit better in the coming months. But again, I think it's important for the government to introduce more of the measures to boost the household income, to stabilize property market, to really sustain such recovery of retail sales in the longer term.
Xia Jiazhi, thank you so much. Nice to see you. Happy Friday. Have a good weekend ahead. Chief China economist there at Credit Agricole. If you're a Bloomberg subscriber, of course, you can catch up with all the interviews that you might have missed on the interactive TV function. That's the one, of course, we just had right now, ahead of the release of key data, of course, tomorrow. Everything from activity numbers to new home prices as well, coming out around Saturday morning Asia time. Of course, if you want to chime in on the conversations, ask questions to our guests, you know how to reach us. Check it out. TV Go. This is Bloomberg. Right, welcome back. Just in time here for a check of some big movers. Oh, this one is fairly hefty in Korea. Korea zinc up 20%. Very, very simple. Tender offer three names, MBK Partners and Youngpoon, launching a tender offer here for the company. Shares were up as much as 24% at one point after that disclosure.
Yeah, we're watching these China Airlines as well. City with a downgrade on China Eastern as well as Southern here. They're talking about concerns of weakening prices and business trip demand that they say still looks pretty weak. So there you go. You are seeing the likes of Air China, though. They're maintaining that one as a buy. And we're watching very closely what goes on when it comes to the whole demand picture, when it comes to travel as well as the summer does start to wrap up. Plenty more ahead. This is Bloomberg. .29 a.m. in Tokyo. Japanese markets are heading to that lunch break, and we are seeing a little bit of, in terms of, I guess, momentum being lost here this morning. Nikkei 225 is down 0.9%. The strength of the yen, I'm guessing, is a big factor there. 140 levels, and if you take a look at what hedge funds are positioning, they're still placing bets in the option market for yen to rally more. There was also a very interesting survey out from us about over half of BOJ watchers still see a rate hike coming in December as well. Does that keep the yen stronger for the next few weeks? Of course, at least until we count down to the mega central bank bonanza next week, Dave.
Yeah, it's a time where do you think bonanza, extravaganza, monetary policy mania? What's a catchier headline?
We always juggle around those three, I think, yes.
I'm more a bonanza person. Central
Party.
bank bonanza.
I want to call it
Party's a good one, too. It's going to be jam-packed next week. In fact, we'll unpack that story later on. And, to Yvonne's point, it's interesting because you have the BOJ as well included in that list. And the Japanese yen is actually, if not already, at the strongest level of the year. So we're at about those levels that we started out the year. We're trading at a 140.90 level here as well. Now, speaking of, Bloomberg Opinion columnist Mohamed El-Erian thinks that markets, to the point that of this lack of consistency in the economic assumptions, a dominant economic view, markets lack that, he says. And then this after swings, of course, we saw in U.S. Treasuries following that U.S. inflation reports midweek. Have a look.
So we saw a 20 basis points round trip in the 2-year. 20 basis points. That's a lot for that maturity. And we learned two things. One is that we have excessive data point dependence. All that happened yesterday in the inflation report, as people know, is that monthly core came slightly harder than expected. Everything else was aligned, and yet we moved 10 basis points up. And then we discovered a second technical, which is money on the sideline being put to work quickly. And that, I think, is our reality, is that we don't have a dominant economic view, so we get swung all over. But the stabilizer right now is this technical of cash on the sideline. Now, financial conditions are good stabilizers with two very important qualifications. They are volatile, and they have as much perception as reality. So we are going to continue with this volatile world until we restore either a dominant economic paradigm or we restore the power of forward policy guidance.
You could argue that even in the face of all of this volatility, it shows how strong the economic system is, that there wasn't some sort of significant disruption. Isn't that sort of the ultimate stress test, that when the benchmark rate swings around by 20 basis points, you don't see any massive selling? Why is it more pernicious than it might seem on the surface?
So I do think the financial system has been strengthened, and in particular the banks. And we are in a much better place than we were in the past. So you don't get the massive balance sheet effects. You don't get the sort of virtuous cycles, good or bad, that can happen from that. But don't forget that we are the benchmark for the rest of the world. And we cause quite a few spillovers that the rest of the world says, you know what, enough now. We've had enough of this. Please get your act together.
That was Mohamed El-Erian there, Bloomberg Opinion columnist and University of Cambridge Queens' college president, speaking with Bloomberg's Lisa Abramowitz. All right, let's talk a little bit more about this big debut coming up here next week. We're talking about Midea Group. This is the Chinese appliance giant set to raise $4 billion in its Hong Kong listing. Let's get more now from our deals reporter, Manuel Belgori. This could be, I think, one of the biggest IPOs we've seen for years in Hong Kong.
Definitely, Yvonne, much needed boost for the city, right? I mean, we haven't seen a big IPO in Hong Kong for so long. It's kind of like we are dusting off the books on how to write about IPOs all of a sudden. But it's exciting. Who doesn't love appliances, right? So
everyone loves a good microwave.
Exactly, exactly. Radio humidifier in this heat here in Hong Kong is much needed. Anyway, as we know, it's a big company listed already in Shenzhen. They're now seeking a listing in Hong Kong. Expected to happen next week. We broke the news yesterday on the IPO getting enlarged. A $4 billion IPO, definitely a big one for what we've seen here lately in the last 3 years, the biggest one in 3 years at least. And it's pricing at the top end of the range. We've seen a lot of demand from investors, including some sovereign wealth funds from Singapore, the likes of GIC and Temasek, for instance, also some private equity firms or alternative asset managers like Hill House as well, showing strong demand. So we'll see. We're in the final stretch, but definitely it's looking good.
What's the pricing looking like? Going to be the specific share price? What do we know?
Yeah, it's in the ballpark of the 50s, around 55.
Hong Kong dollars.
Hong Kong dollars, yes. That's the top end, and the overall size is $4 billion, roughly speaking. Yes.
Okay.
Yeah.
Manuel, we'll see. Oh, well, before I let you go, what do you think the secondary, the day it trades, what do you think it's going to trade at? Just fancy a guess.
I mean, this is at a time when we talk about consumption downgrades, right?
I know. Yeah. Who knows? That's my guess is as good as anyone's. but I mean, we've seen both sides, right? We've seen some smaller IPOs doing quite well, others doing not so well. I mean, this one based on demand and also the lockup they have from some cornerstone investors, it should be quite a stable one. I would say
it's a big one too, and quite a well-known company, right?
Yeah.
Who doesn't love appliances? That should be on a T-shirt, actually. Manuel, thank you so much. Manuel Belgori there on the big one coming, of course, Tuesday next week. Now, let's talk about Ant here. And I have to correct myself, too, when we talk about the Ant story. The IPO was actually pulled in 2020. I mentioned in the last hour it was 2019. And, well, on that story, the sources say that tell Bloomberg that Jack Ma, the backed Ant Group, of course, is refinancing offshore credit line, $6.5 billion. The move, of course, comes after that once dominant fintech company expands its global operations and seeks to recapture some of the lost glory before, of course, that crackdown a few years back. Stephen Ingles, Chief North Asia correspondent, is here with us to talk us through what we know about this, Steve.
Ant's gone through that painful rectification, right? So after that IPO was scuppered in the last minute, the 11th hour, and then went through the forced restructuring, if you will, and also essentially being classified as a financial company more so than a tech company, and under the regulation of financial regulators. So I think this is a company, obviously, we don't have imminent plans for an IPO. When we had that, it was going to be a world-beating IPO, I believe in Shanghai and in
Hong Kong.
Hong Kong and New York, right? It was going to be a dual. Boy, my memory is shot, but it was going to be a dual listing, right? And it was going to be a world beater, right? And the valuation back then was about $280 billion for this company. Earlier this year, when there was a share buyback of private investors, the valuation was about $78 billion. So it's come down quite a bit. They need to find new avenues of growth. Their main revenue generator pre-IPO breakup was Jiebe and Huabei, which are the lending platforms. They were supposed to be micro-lending platforms, but they ended up being quite large, serving a need in the economy of providing short loans, but it was a mass. So there was financial risk, obviously. So let's fast forward to today. The sources are telling us that they are refinancing a offshore line of credit to the tune of $6.5 billion. $1.5 billion of that will be allocated quota will be allocated to Alipay International. And now this has been a big priority with the slowing economy in China and increased regulation on the financial services. They have been expanding overseas. In fact, they've been expanding their payments network, Alipay Plus, across Southeast Asia. In fact, the network connects more than 88 million merchants in 57 countries, according to the company, as of early March. So they are expanding abroad. They are putting in their large language models of AI into these services to kind of grow as a tech company. Now, maybe this is a precursor to eventual courting of international and institutional investors and an IPO. You'd rather be sort of lumped into the category as a high-flying tech than a more stagnant fin part of fintech.
And the timing is right. I mean, we heard from the regulators just a few weeks ago basically calling an end to this sort of crackdown in the tech sector. So how does Ant sort of redefine itself and build out those tech offerings?
Yeah, I think they do emphasize the tech as far as fintech. Their bread and butter is still going to be Alipay and Alipay Plus abroad. And they have about a billion users, I think, signed up for Alipay, Zhifubao, as it's known. It's ubiquitous across China. But they also have this service called Zhishaobao, which is a life assistant. You can order food, you can order tickets, you can do a number of different things with this app that uses AI, the large language model that has been approved by the Chinese government for Ant, and then it kind of channels customers through the different services that you can get on Alipay, which is Zhifubao. So that's one area where they can really build it out.
Steve, thank you. Stephen Ingle there, our chief North Asia correspondent. Some other corporate stories that we're tracking for you today. General Motors is said to be in discussions to buy EV batteries that would use technology from CATL and be assembled at a new plant set to be built in the U.S. Sources say the factory will be funded and operated by Japanese firm TDK. And they say the deal could change depending on the outcome of the U.S. presidential election in November. Millennium Management is looking to raise between $7 and $10 billion of new capital in a structure aimed at giving the firm a more permanent source of cash. The firm is taking a page from private equity firms and raising money that's callable rather than taking it all at once. The new iteration allows clients to make pledges that Millennium can tap over time. We have plenty more ahead. This is Bloomberg. Welcome back to the China Show. Here are some of the major stories we're following from around the world. Donald Trump has ruled out more debates with Democrat nominee Kamala Harris, and he says their first debate was moderated with a bias against him. Harris's odds of winning the presidency have risen following the showdown, and she is calling for another face-off. Meanwhile, the DOJ says Russia, Iran, and China are increasing attempts to stoke divisions within the U.S. ahead of November's election. A senior U.S. official has warned European allies that Chinese companies are increasingly involved in boosting Russia's war economy. Biden administration officials are touring European capitals to share information with partners about China's cooperation with Russia and the potential implications. The U.S. president hopes to unite European allies on the issue. China has rejected U.S. accusations of supporting Russia's war.
Now, last week, the U.S. warned American businesses operating here in Hong Kong of more legal risks due to national security laws. But Bloomberg Opinion columnist Karishma Vaswani thinks that the city's story as a financial center is not over. She joins us right now from Singapore. Yeah, Karishma, what do you see as Hong Kong's future to be?
Yeah, David, I'm sure you hear this all the time when you talk to, the both of you talk to people on the program and in your daily lives in Hong Kong. You know, the narrative that Hong Kong is over and the fact that China is now has increasing control over the once premier Asian financial hub means that people shouldn't be doing business there. Now, in my column, I argue that that's absolutely wrong. Hong Kong is not over. It's just different. The future for Hong Kong is intrinsically linked to China, and that means that China's influence will grow, but it's also linked to China's partners, countries like Russia, for instance. And now we heard some of that in the U.S. business advisory that came out, as you were saying, a few days ago. What the US is alleging is that Hong Kong's position in the global financial world is being compromised both by these Beijing-backed national security laws, but also because it claims and asserts in this advisory because of possible sanctions violations that Hong Kong could also be involved in. Now, Hong Kong, for its part, the government has come out with a strident rejection of what it calls an opportunity to create panic on the part of the US and has maintained that it is consistently very high up in global rankings, for example, on the World Competitive Index and in terms of attracting foreign direct investment.
So how do you think companies that operate in Hong Kong, for example, how are they going to navigate this sort of new geopolitical landscape?
Well, you know, Yvonne, both you and I, well, all three of us have kids, right? And every time you're in a situation where you don't know what to do, I think going with the truth with your children as well as in business is an ideal way to look at things. And I think Hong Kong authorities just need to wake up and realize this is their new reality. And they need to start going with that narrative. And companies that are based there need to also accept that reality. That means making sure that you have the right compliance in place, putting in infrastructure that allows you to ward off potential risks. Hong Kong has had so much bad hits, rather, I should say, in terms of reputational hits to damage its reputation in recent months. What it really needs to do right now is apply some urgent damage control.
All right, Karishma, thank you. Karishma Vaswani there, our Bloomberg Opinion columnist on the future of Hong Kong. Make sure to check out her column this morning. You can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter that is out every Thursday. You can sign up through the website, bloomberg.com/newsletters. Plenty more ahead. This is Bloomberg.
All right. I don't think we talk about central banks enough here in the show. Let's do that just now. Central banks globally are led by the Fed, of course, appear to be finally wrapping up this hard-won victory over inflation. But winning that battle has also exposed the limitations of their ability and their approach, especially against challenges such as climate change, for example. Bloomberg Originals takes a closer look at these challenges.
In a way, the COVID pandemic and the inflation that followed has been a Wizard of Oz moment for the Fed and the ECB and the Bank of England and other central banks. There's a famous moment where Dorothy's dog, Toto, pulls back the curtain and reveals the wizard to be just a man with a loudspeaker.
The lockdowns of the pandemic caused severe supply shocks as factories shuttered around the world. Meanwhile, government stimulus meant to keep the economy afloat drove a surge in inflation.
We thought they were maestros, all-powerful geniuses. Central bankers were slow to recognize that inflation was taking off, and after it did take off, they didn't have the tools to bring it quickly under control.
When they decide they had to make this course correction by raising rates rapidly, they did go for it. Powell was very clear that they will do whatever it takes to bring price stability back. I think right now, many people thought that the Fed has redeemed themselves.
But at the same time, the world has changed.
We're living in a world which has swung from globalization to deglobalization, and where climate change is a new and important factor. We now live in a world of hot wars, Russia invading Ukraine and turning off gas supplies and oil supplies for Europe, an expanding conflict in the Middle East.
The Fed's policy tools can only raise or lower aggregate demand. It is not meant to affect supply in the economy. What can affect supply in the economy? Well, fiscal policy can, tax policy can.
So there's a big debate underway about what new tools are required to control prices and keep inflation low and stable, and many of those tools are being built outside of the remit of central banks. I think in the future, we're not going to be talking about maestros. Central banks have won the battle to get inflation back to their 2% target. In the years ahead, we may discover that they have lost the war over how management of inflation works.
And you can watch the full Bloomberg Originals documentary now on the terminal and on Bloomberg.com. Yeah, and it sets the stage of what's to come next week, right? It's going to be pretty busy when it comes to central banks. In terms of decisions, of course, it's the Fed, the BOJ. Those are the key ones there. But definitely when you take a look at the rest of the world, we're talking about Indonesia, Taiwan, Hong Kong, in this part of the world, the BOE, I forgot about that. But yeah. The big ones, though, of course, we got to talk about those first.
Yeah, then we have Japan, we have the Fed, and I think, interestingly, the comment coming through from the former New York Fed President Bill Dudley talking about how there is scope for the Fed to actually move by 50 at next week's meeting. So it certainly complicates the approach, but a lot of these central banks will, I guess, in some ways need to wait for what the Fed does before they can probably decide what they do, particularly those that are watching trade flows and exchange rates, albeit, of course, not at very extreme levels as of weeks back. But what the Fed does still affects, of course, what they do.
That Wall Street Journal report I thought was quite interesting, that the Fed is actually maybe in discussions about still that 50 basis point cut, right? Yeah. And is it better to start big or small? That's sort of the debate that they kind of highlighted there. If we actually do see in those dots that they're projecting about 100 basis points of cuts this year, why then start small? Right?
If you're going to get there anyway.
If you're going to cut deeper later on. I mean, that's a pretty awkward question that they're going to have to answer if they do kind of go this way. Yeah.
Well, the press briefing is going to be interesting.
Yes.
Certainly. So we'll stay tuned, of course, for a massive week in central bank decisions next week to wrap up what's really been a challenging month so far for equity markets. Yes, we're doing okay this week, but the start to the month was really, really toxic for risk assets right now. What's helping the case, I think, to some extent, was the ECB, the BOJs next week. The yen is trading, I think, almost at the strongest level already of the year.
Yeah.
Currently on dollar yen, and we're seeing that tailwind coming through across Asian FX today. Where you look at this over the last 24 hours or so, every single currency, I think the Asian dollar index, there is a gauge of that, is on track for one of its best days in about 3 weeks or so. So at least this is doing well, and the dollar is on track for yet again another week of weakness here.
Yeah, and that's why you're seeing gold actually continue to extend higher in this record rally, right? It's interesting, right? As soon as that ECB decision came through, we continue to watch dollar drop, and then of course gold continue to rise, and that's really helping some of these miners here this morning. Take a look at how we're seeing Evolution Mining is up some 8%.
Wow.
Jiaojing Mining in China also up close to 5%. So we're talking about, 2564 levels for gold right now. China property is also one to watch. We're also seeing a pretty decent rally underway there. Of course, there's a lot of anticipation of what's to come in this MPC meeting later on today. Not just when it comes to pension reform, that's one thing, but the mortgage rate story, obviously what Bloomberg sources have been telling us, that they are planning to cut those even existing mortgage rates. That could be quite helpful in terms of the households and, of course, consumers.
You're right. And I suspect that on Monday we'll be talking about a lot. There's a different tone to the conversation around China, because we potentially have something on property. We potentially have something on the pension age reform. We are also, by the way, in the window for credit numbers to come through, on top of the data set you're looking at on your screens, on top of the home prices, we should also be getting. So Monday's going to be jam-packed, and I think fairly awkward is really when you look at the data set tomorrow. It comes on the back of it being released on a weekend, which is not normally the case, but I guess it gives markets time to digest it. And as a side note, going to the weekend, it's probably something more constructive to look at than, in my case, gym selfies. That typically inundate my social feeds on the weekends. I keep that on your phone.
I don't know what your algorithms are
keep that
telling
on your
you.
Phone.
But yes, industrial production of 4.7%. That would be a slippage of by a fourth straight month. That would be the longest deceleration, almost 3 years. For that sort of one to watch. And retail sales obviously still looking like it could be weak, with that survey saying 2.5%. That's it for us here on the China Show. Have a great weekend. We got Bloomberg Markets Asia coming up next.